The worst recession in modern American history is about to slam into 10 U.S. states so hard that their economies won't just stumble, they'll crater. Let me ask you something. Are you aware that foreclosure activity just surged 20% year over year during what's supposed to be an economic expansion? That housing inventory in certain states has exploded by over 50% while buyers vanish from the market. That state governments are staring down fiscal deficits so catastrophic that essential services are already being cut before the recession even hits full force. What we're about to walk through isn't speculation. This is financial damage happening in real time, documented in the data, and these 10 states are standing at ground zero with zero capacity to absorb what's coming. Before we go any further, if you want to stay ahead of economic shifts that could affect your financial future, hit that subscribe button and turn on notifications. Now let me show you exactly which states are facing economic collapse in 2026 and why the numbers reveal this is unavoidable. Let's break down the 3 triggers that are converging to create this catastrophic state-level collapse. Trigger number 1 is the housing market implosion that's already underway. Recent data from Redfin shows that 34% of home listings nationwide had price reductions in October 2025, meaning roughly 1 out of every 3 sellers is cutting prices just to attract any interest at all. But in certain states, that figure climbs above 40%, with inventory levels surging 53% above historical norms while buyer demand collapses. CoreLogic data reveals that investor purchases, which propped up prices for years, have dropped 45% in key markets, removing the artificial floor that prevented corrections. Foreclosure filings are climbing to 1 foreclosure for every 1,929 homes in the hardest-hit states, and this is happening while unemployment is still relatively low. When the recession accelerates and job losses mount, these foreclosure rates will multiply. Trigger number 2 is the fiscal crisis at the state government level that eliminates any safety net. States that relied on explosive population growth during the pandemic are now watching migration collapse by 62% in some cases, taking tax revenue with it. States carrying massive unfunded pension obligations, some exceeding $144 billion with funding ratios below 50%, have no mathematical way to meet those commitments without either defaulting or slashing services so severely that economic activity grinds down further. Property tax revenues, the backbone of local government funding, are about to crater as housing values correct downward by 15% to 25% in overheated markets. States already running budget deficits of $3 billion to $6 billion annually before recession hits have zero fiscal capacity to stimulate their way out or provide meaningful assistance when unemployment spikes. Trigger number 3 is the employment and business contraction that's accelerating faster than national averages in these vulnerable states. Unemployment rates in certain states have already climbed from 3.7% to 4.3% over just 6 months, outpacing national trends. Bankruptcy filings have jumped to over 1,200 cases in states where business formation boomed artificially during the pandemic. The Case-Shiller Index shows price appreciation in previously hot markets slowing to just 1.5% year over year compared to gains of 15% to 20% just 2 years back, signaling that the wealth effect driving consumer spending has reversed. When these 3 triggers, housing collapse, fiscal insolvency, and employment contraction, hit simultaneously in states with no buffers and massive structural vulnerabilities, you don't get a recession, you get an economic collapse. Number 1 on this list is Florida, and what's happening there represents the most dramatic reversal of economic fortune in modern state history. Florida just recorded the largest year-over-year surge in housing inventory nationwide, with listings jumping 22% compared to last year and sitting 53% above the 5-year average. Let me put that in perspective. Cape Coral saw inventory jump 51% in a single year. Fort Lauderdale rose 30%. These aren't small adjustments. This is a market flooding with desperate sellers while buyers disappear. Recent data from Redfin shows that 34% of Florida home listings had price reductions in October 2025, the highest rate in the nation. For a state that attracted 222,100 net domestic migrants in 2022 at the peak of the pandemic exodus, the collapse is stunning. That migration figure fell to just 68,043 in the most recent data, a drop of 69% that's gutting the demand that propped up Florida's housing bubble. Here's what makes this especially dangerous. Florida has no state income tax, meaning it relies heavily on property taxes and sales taxes tied directly to real estate transactions and consumer spending. As home values correct downward by an estimated 15% to 25% over the next 18 months, property tax revenues will crater. Sales tax collections are already softening as the wealth effect reverses and consumers pull back spending. But the housing crisis is just one dimension of Florida's vulnerability. The state faces a property insurance catastrophe that's driving costs to unsustainable levels. Homeowners insurance in Florida now averages $11,000 annually compared to a national average of $20,500, representing a 340% premium that's pushing middle-class families to drop coverage entirely or flee the state. 6 major insurers have already exited the Florida market since 2022, leaving the state-backed Citizens Property Insurance as the insurer of last resort, now covering over 1 million policies and carrying exposure that would bankrupt the state in a major hurricane season. CoreLogic data reveals that investor purchases, which made up 28% of Florida home sales at the peak, have plummeted 45% as out-of-state investors realize the combination of falling prices, insurance costs, and property taxes make Florida rental properties cash flow negative. When investors who paid premium prices during the boom start dumping properties into an already saturated market, foreclosures will accelerate dramatically. Florida's foreclosure rate has already climbed to 1 filing per 1,129 housing units, double the national average, and unemployment hasn't even spiked yet. The state entered 2025 with a fiscal cushion that's evaporating rapidly as revenue projections based on continued growth and migration prove fantasy. Counties like Miami-Dade, Broward, and Palm Beach are projecting budget shortfalls exceeding $800 million combined as they face the reality of falling property values, declining sales tax revenue, and infrastructure costs for climate adaptation that run into tens of billions. Florida built an economic model based entirely on perpetual population growth and ever-rising home values. That model just broke, and there's no safety net left. Number 2 is Illinois, a state that was already in fiscal crisis before recession clouds gathered and now faces insolvency that will cascade into economic collapse. Illinois is trapped with $144 billion in unfunded pension obligations, the result of decades of political decisions to promise benefits without funding them. The state's pension funding ratio sits at just 46%, meaning for every dollar Illinois owes retired public employees, it has 46 cents set aside. That's not a crisis waiting to happen. It's a mathematical certainty of default. Illinois carries the highest state debt ratio in the nation at 468.7%, with total state debt exceeding $200 billion when you include both bonded debt and pension obligations. Annual pension payments now consume 25% of the state's general fund revenue, crowding out spending on education, infrastructure, and services that might otherwise stimulate economic activity. The state has been hemorrhaging population for years, losing over 400,000 residents between 2020 and 2023, taking their tax contributions with them and leaving a smaller base to fund those massive obligations. When recession hits and tax revenues fall further, Illinois will face an impossible choice: default on pension obligations and trigger a constitutional crisis, or raise taxes so high that the remaining productive residents and businesses accelerate their exodus. The housing market in Illinois reflects the doom loop already underway. Chicago area home sales have fallen 12% year over year while inventory climbs, with the city itself losing population every single year since 2015. Property taxes in Illinois rank second highest in the nation at an effective rate of 2.08%, meaning a home valued at $300,000 carries an annual property tax bill of $6,240. and those rates are climbing as municipalities desperately try to cover pension costs and shrinking revenue bases. Recent data shows Illinois foreclosure filings jumped 18% compared to last year, concentrated in the Chicago metro area and downstate counties where manufacturing job losses are mounting. What's particularly devastating is that Illinois has no growth sectors to offset these structural problems. The state lost corporate headquarters throughout the 2020s as companies fled high taxes and dysfunction. Manufacturing employment continues declining as plants close or relocate to right-to-work states with better fiscal positions. Even the financial services sector centered in Chicago is contracting as firms shift operations to lower-cost markets. Illinois entered the recession with unemployment at 4.3%, already above the national average, and job losses in the coming downturn will spike that figure towards 7% or higher. The state has a deficit projected at $3.2 billion for fiscal 2026 before recession impacts hit revenue projections. There's no borrowing capacity left at reasonable rates given the credit downgrades Illinois has already suffered. The state government lacks the fiscal tools to stimulate the economy or provide a safety net, and the pension obligations keep growing regardless of economic conditions. This is economic collapse in slow motion that's about to accelerate. Number 3 is California, and while the state's massive size and economic diversity have masked the crisis building underneath, the scale of what's coming will overwhelm even California's advantages. Let me show you what the housing data reveals. Inventory levels in Southern California markets have surged 41% year over year, with price reductions appearing on 38% of listings, as sellers confront the reality that buyers at inflated prices have vanished. The median home price in Los Angeles County, which peaked at $912,000 in mid-2022, has already corrected to $798,000, a 12.5% decline, and that's before recession impacts accelerate. CoreLogic data shows pending home sales down 23% compared to last year in the San Francisco Bay Area, where the tech industry layoffs that started in 2023 have permanently reduced the high-income buyer pool that sustained prices. California's property tax system under Proposition 13 means that as turnover slows, new assessments at current market values get delayed, but when the correction is complete, local governments will face a revenue crisis as property tax growth stalls out completely. California has another dimension of vulnerability that will prove catastrophic in recession. The state relies on personal income taxes for 70% of general fund revenue, and those income taxes are concentrated among high earners whose compensation is tied to stock options, bonuses, and capital gains. When the stock market corrects during recession and high earners see their total compensation drop 30% to 50%, California's revenue will collapse far faster than the economy overall. Here's the part most people aren't talking about. California entered 2025 projecting a budget deficit of $68 billion, the largest in state history, requiring massive cuts even before recession hits. The state's unemployment insurance fund remains $20 billion in debt to the federal government after pandemic outlays, and when unemployment spikes during recession, that deficit will explode further while benefits get paid out. California has $165 billion in unfunded pension liabilities for state employees through CalPERS and CalSTRS, with funding ratios that look sustainable in boom times, but will crater when investment returns go negative during market corrections. The state's regulatory environment and cost structure mean that businesses facing recession will accelerate their departures rather than weather the storm in California. Recent data shows net domestic migration out of California reached 342,000 people in 2023, the largest outflow in state history, with middle and upper middle-class families leading the exodus as they realize the California dream has become mathematically unattainable. Foreclosure activity in California jumped 17% in the third quarter of 2025 compared to the prior year, concentrated in Inland Empire markets like Riverside and San Bernardino, where pandemic-era buyers stretched to afford homes that have now lost 18% of their value. What makes California's collapse particularly significant is the scale. This is the world's fifth largest economy imploding, And when California enters fiscal crisis and recession simultaneously, the ripple effects will hit nationwide. The state lacks the political will to make structural reforms, instead relying on boom-time revenues that are about to vanish for years. Essential services will get cut, infrastructure will deteriorate further, and the business environment will become even more hostile, creating a doom loop of decline that feeds on itself. Number 4 is Texas, and this might surprise people who bought into the narrative of Texas as the promised land of business-friendly growth. Here's what the data actually shows. Texas attracted massive migration during the pandemic years, adding over 470,000 net domestic migrants in 2022 alone, but that boom created a housing bubble that's now bursting in spectacular fashion. Inventory in the Dallas-Fort Worth metro has surged 38% year over year, with nearly 40% of listings showing price reductions as sellers panic over stalled transactions. Austin, the poster child for pandemic-era migration driven by tech workers, has seen inventory explode 53%, while home prices have already dropped 11% from peak. Recent data from Redfin shows Austin has the second highest rate of price reductions in the nation, at 42% of listings, behind only Florida markets. The Case-Shiller Index for Austin shows price appreciation slowing to just 1.2% year over year, compared to gains of 35% in 2021-2022, a deceleration that signals the correction is just beginning. San Antonio and Houston show similar patterns, with inventory climbing above 4.5 months of supply, well above the balanced market level of 3 months, and heading toward the 6-month level that defines a buyer's market where prices fall rapidly. Texas has a structural vulnerability that will prove devastating in recession. The state has no income tax and relies heavily on property taxes and sales taxes for revenue. Texas property taxes are already the 6th highest in the nation at an effective rate of 1.60%, and as home values correct downward, local governments and school districts will face massive shortfalls. But here's what makes Texas especially vulnerable. The state's economic boom was driven substantially by the oil and gas industry, which is now entering a period of reduced capital expenditure and employment contraction as energy prices moderate and global demand softens in recession. Manufacturing activity in Texas, particularly the chemical and refining industries clustered along the Gulf Coast, are cyclical sectors that contract sharply during economic downturns. Recent data shows Texas manufacturing activity indexes falling below 50, indicating contraction, for 5 consecutive months. The construction sector, which employed hundreds of thousands during the building boom, is already shedding jobs as new home starts have plummeted 31% compared to peak levels. Texas unemployment has ticked up from 3.7% to 4.1% over 6 months, a rate of increase that typically precedes rapid acceleration when recession hits. Foreclosure filings in Texas jumped 22% year over year in the third quarter of 2025, with concentrations in suburban counties surrounding major metros where pandemic-era buyers stretched to afford homes. Counties like Hayes, Williamson, and Comal around Austin, and Denton and Collin north of Dallas, are showing particular stress with foreclosure rates climbing above state averages. Texas has another problem that's about to hit hard. The state's grid infrastructure remains fragile after the 2021 winter storm disaster, and the massive power demands from data centers and new industrial facilities are straining capacity. When recession reduces tax revenues, the investments needed for grid modernization will get deferred, increasing the risk of future failures that will drive more businesses and residents to question Texas viability. The migration that powered Texas boom has already reversed, with net domestic migration falling 62% from peak levels as people realize that lower taxes don't offset higher property costs, insurance rates that rival Florida, and infrastructure that can't reliably deliver basic services. Texas built an economic model on cheap land, cheap energy, and minimal regulation attracting endless growth, but that growth is stopping right as all the infrastructure bills come due, and there's no fiscal capacity to pay them. Number 5 is Arizona, where the housing bubble has inflated so dramatically that the correction will wipe out a generation of wealth and push the state into depression-level conditions. Arizona home prices increased 56% between 2020 and 2023, driven by California exodus migration and investor speculation that created bidding wars and pushed values far beyond what local incomes could support. Now that bubble is deflating in real time. Phoenix area inventory has surged 47% year over year, the second highest increase in the nation, with 36% of listings showing price reductions. The median home price in Phoenix, which peaked at $445,000, has already dropped to $412,000, an 8% decline, and sales volume has collapsed 24% compared to last year as buyers refuse to catch falling knives. Maricopa County, home to Phoenix and 60% of Arizona's population, issued 1,847 foreclosure notices in October 2025 alone, a 28% increase compared to the prior year. Tucson shows even worse deterioration, with inventory up 52% and prices down 9% from peak, as the smaller market proves more vulnerable to shifts in sentiment. Here's the systemic problem Arizona faces. The state's economy is substantially dependent on construction and real estate, sectors that provided nearly 18% of employment during the boom. As construction of new homes has fallen 38% from peak starts and existing home sales crater, tens of thousands of jobs in construction, real estate services, mortgage lending, and related industries are vanishing. Arizona's unemployment rate has jumped from 3.5% to 4.2% in just 7 months, one of the steepest increases in the nation, and that's before the full recession impact hits. Arizona has a water crisis that's about to collide with the housing collapse to create a doom loop of declining values and population exodus. Recent restrictions on new construction in some areas due to groundwater limitations are forcing developers to abandon projects, leaving workers unemployed and creating inventory of half-finished developments that will sit abandoned. The Arizona Department of Water Resources has cut water allocations from the Colorado River by 21% compared to historical averages, forcing agriculture cutbacks and raising questions about whether the Phoenix metro can sustain current population levels, let alone future growth. That uncertainty is now priced into home values as buyers question whether Arizona properties will be viable long-term. Arizona's fiscal position offers no cushion for recession impacts. The state has $59 billion in total debt when including unfunded pension and healthcare obligations, with pension funding ratios around 72%, better than Illinois, but still vulnerable when investment returns go negative during market corrections. The state entered 2025 with a balanced budget predicated on continued growth, but revenue projections are already missing targets as sales tax collections soften and property tax growth stalls. When recession hits and unemployment spikes towards 7%, Arizona will face deficits exceeding $2 billion annually with no fiscal tools to respond. The state's dependence on tourism and hospitality, sectors that employ 12% of the workforce, means recession impacts will hit harder as discretionary travel spending collapses and resorts, golf courses, and attractions shed workers. Arizona's combination of housing bubble collapse, water crisis creating long-term viability questions, heavy dependence on cyclical industries, and lack of fiscal buffers make this a state facing economic depression rather than just recession in 2026. Moving to number 6, Louisiana faces economic collapse, driven by a combination of energy sector contraction, catastrophic insurance costs, and fiscal mismanagement that's left the state with zero capacity to absorb recession shocks. Louisiana's economy remains heavily dependent on oil and gas extraction, refining, and petrochemical manufacturing, industries that are shedding jobs and investment as energy markets soften. Recent data shows Louisiana's unemployment rate has climbed to 4.6%, already among the highest in the nation, before recession accelerates job losses. The state's coastal parishes face property insurance rates that have tripled since 2020, as climate risks make coverage unaffordable or unavailable, driving population decline in areas that were already economically distressed. Louisiana entered 2025 facing a $700 million budget deficit, with few options beyond cuts to education and healthcare that will further degrade economic prospects. The state's unfunded pension obligations exceed $19 billion with funding ratios below 65%, and pension costs consume an increasing share of state revenue, just as that revenue base is shrinking. Foreclosure rates in the New Orleans metro and Baton Rouge have jumped 25% year over year as job losses mount and underwater homeowners abandon properties in declining markets. Louisiana is losing population in net domestic migration, down over 48,000 residents between 2020 and 2023, as younger educated workers leave for better opportunities and retirees flee insurance costs. Number 7 is New Jersey, a state carrying the second highest property taxes in the nation at an effective rate of 2.23%, while facing the same pension crisis dynamics as Illinois. New Jersey has $194 billion in unfunded pension and healthcare liabilities, a per capita burden that exceeds even Illinois when you account for population size. The state's pension funding ratio sits at just 58%, and annual pension costs consume 18% of the budget, crowding out other spending. New Jersey property taxes average $9,190 annually on a median value home, pricing middle-class families out of home ownership and driving steady population exodus that's accelerated during pandemic years. Net domestic migration out of New Jersey reached 68,000 in 2023, continuing a decade-long trend that's shrinking the tax base while fixed obligations grow. The state entered fiscal 2026 with a deficit projected at $4.3 billion before recession impacts, and there's no realistic path to close that gap beyond further tax increases that will accelerate departures. New Jersey's housing market shows stress with inventory climbing 19% year over year, and sales volume down 16% as buyers balk at the combination of prices, property taxes, and economic uncertainty. When recession hits and financial services jobs in New York City get cut, the New Jersey suburbs that house those workers will see foreclosures spike and tax revenues crater simultaneously. Number 8 is Nevada, where the Las Vegas economy faces collapse as recession slams the gaming and hospitality industries that provide 31% of employment. Nevada's unemployment rate has already climbed from 3.8% to 4.7% in just 8 months, the fastest increase in the nation, as casino revenues soften and hotel occupancy rates fall below break-even levels. The housing market in Las Vegas shows bubble dynamics with inventory surging 44% year over year and prices down 7% from peak as speculation reverses. Nevada has no state income tax and relies almost entirely on gaming taxes and sales taxes for revenue, both of which collapse during recession when discretionary spending vanishes. The state entered 2025 with minimal fiscal reserves, less than 5% of annual spending, meaning budget cuts will start immediately when recession hits. Nevada's foreclosure rate has jumped to 1 filing per 2,100 homes, reflecting an economy where job volatility makes homeownership precarious and underwater borrowers walk away quickly when values fall. The state's population growth, which averaged 47,000 annually during pandemic years, has reversed to net domestic outmigration, as the boom driven by Californians seeking lower costs proves unsustainable when housing prices and insurance costs climb toward California levels while wages remain far below. Number 9 is South Carolina, experiencing housing market stress concentrated in formerly hot markets like Charleston, Myrtle Beach, and Greenville, where inventory has surged 37% year over year. South Carolina attracted substantial migration from the Northeast during pandemic years, but that influx has collapsed by 58% from peak, leaving markets oversupplied with new construction built for demand that no longer exists. Counties like Dorchester, Kershaw, and Berkeley show particular distress with foreclosure filings up 31% compared to last year. The state's manufacturing base, particularly automotive and textile industries, is contracting as recession reduces demand and manufacturers shut plants or reduce shifts. South Carolina unemployment has ticked up from 3.2% to 3.9%, and the state's limited fiscal capacity means unemployment benefits and assistance will run out quickly when recession accelerates job losses.